Silver investors. They spent 3 months defending $80 like it was a national border. Yesterday, that line didn't just break, it detonated, taking everyone from the January $121 highs down to $82 in what feels like coordinated market warfare. I'm OG John AG, and in this video we're going to talk only about silver. How this January crash to today's $80 low follows the exact same Wall Street playbook of manipulation, capitulation, and reload. Why the Comex numbers scream rigged game louder than ever, and what it actually means when retail gets dumped on again while institutions quietly load up at your panic price. Is this market even real anymore? Or just a machine designed to extract your capital every time you start believing the fundamentals? This is financial warfare education, not financial advice. I don't sell signals, courses, certainty, or silver. Anyone using my name to do any of that is a criminal. Verify everything, your decisions, your responsibility. Let's go. Segment 1, the January 121 $82 replay. Same script, same actors, same victims. Let's start with the timeline nobody wants to admit is repeating itself with surgical precision. January 29th, 2026. Silver hits $121.80 intraday, a level not seen since the 2011 mania. Retail euphoria peaks. Group chats explode with $200 next screenshots. YouTube thumbnails scream silver to the moon. Physical dealers report phone lines melting down. Then, overnight into January 30th, the trap springs. Silver gaps down to $115 pre-market. By New York Open, $110 is gone. Lunchtime, $106.40 low, a 15.6% single-day destruction on volume 3.2x average. Sound familiar? Fast forward to yesterday, March 3rd. Friday closes $93.10. Monday tests $88. Tuesday opens $87.50, fakes $88.20, then detonates to $82.17 close. Another 11.8% wipeout on 2.8x volume. Two crashes, 6 weeks apart, identical footprints. Both hit after multi-month grinds higher. Both featured massive volume climaxes. Both closed in the lower 20% of their intraday range. Both followed periods of intense retail FOMO. Both occurred against a backdrop of tightening Comex registered inventory. Both saw Shanghai physical premiums spike immediately after, while Comex paper lagged. This isn't random volatility. This is pattern. Wall Street Silver Playbook, chapter and verse. January wasn't a one-off correction. Yesterday's $82 wasn't geopolitical fade. They were engineered capitulation events, designed to shake out maximum retail at minimum price so institutions could reload for the next leg higher. The math doesn't lie. The volume bars scream it. The deceleration into close proves it. But to understand why this keeps happening, why silver specifically gets this treatment, you need to understand the machine behind the screen, the Comex mechanism, the concentrated short positions, the incentives that make dumping silver phir not just profitable, but necessary for certain players to survive. Let's unpack the anatomy of these crashes so you stop being the victim next time. Segment 2, Exhaustion Candle Forensics, dissecting January and March's identical DNA. Exhaustion candles aren't some abstract trading theory from a 1987 book nobody reads. They're measurable, repeatable events where selling pressure reaches mathematical exhaustion, and institutions know exactly how to engineer them. Let's do side-by-side forensics on January 29th versus March 3rd to prove the pattern is no coincidence. Volume climax, the smoking gun. January 29th, 168,400 contracts. 3.2x, 20-day average of 52,600. March 3rd, 182,000 contracts. 2.8x average of 65,200. Both days saw volume 2.53.5x normal on down moves with wide range. That doesn't happen organically. That happens when every stop loss, margin call, and panic seller hits eject simultaneously. Intraday range explosion, the panic print. January 121.80 high, 106.40 low, 15.4 points, 12.6% range. March 88.20, 82.17, 6.03 points, 6.8% range. Both 60-70% wider than 60-day average true range. Both featured early fakeouts, January 121.80 trap above prior high, March 88.20 test above Monday high, followed by relentless plunges targeting obvious support clusters. Deceleration pattern, sellers dry up. January 15th min chart, heavy red volume 10 a.m. 1 p.m. ET, 92K contracts, fading to 28K by 2 p.m., trickle 14K final hour, March identical, 98K contracts 11 a.m. 2 p.m., 41K 2 to 3 p.m., 12K final hour, momentum dies because weak hands exhausted, no sellers left, close location, weak bear conviction, January close 108.20, lower 22% of range. March 82.17, lower 18% of range. Real breakdowns close near lows on building volume. Exhaustion closes weak after climax because bears ran out of ammo. Post-climax behavior, the V reversal proof. January 30th, gap to 110.50 open, closed 114.80, 6.1%. March 4th, pre-market, as this records, Asia bidding 83.80, 84.20. Globex indicating $85 open. Pattern holds, 5 identical proofs, 0 chance of coincidence. These are manufactured capitulation events. Wall Street dumps silver, phir because the pattern works. Every single time. Segment 3, the Wall Street playbook, why they must dump silver. Every rally. Wall Street doesn't dump silver to $82 because they see $70 coming. They dump it because their survival depends on it. Let's decode the incentives driving this machine. The concentrated short problem, Comex CFTC commitment of traders data, Feb 24th release. Top 4 shorts control 48.7% of open interest. Number 1 short alone, 22.3%, 112 emits Oz equivalent. That's one entity promising delivery on silver it doesn't own, against registered inventory of just 42 Oz total. When silver grinds to $93, $121, their mark-to-market losses explode. Margin calls mount. They face 2 choices. Cover immediately at retail prices, 93, 121. Lose face, lose money, admit defeat. Engineer capitulation, shake out leveraged longs, trigger stops, reload cheap. Choice number 2 wins every time. January 121, $106, forced 23% of spec longs to exit. March 93, $82 forced another 18%. Same shorts covered both times, then flipped long below retail cost basis. The Comex leverage weapon 1 silver contract, Nolser $5,000 Aussie, $422,500 notional at 84.50. Initial margin, $74,200, 17.6% of value. A 12% adverse move, shower full liquidation. Perfect for shaking retail while banks trade unleveraged physical or deep options. The retail liquidity pump retail provides perfect exit liquidity. FOMO buys $121 high. Panic sells $106 low. Institutions sandwich both sides. Your group chat bravado funds their P&L. This isn't market making, it's extraction. January and March crashes weren't bear markets. They were loading zones for the banks who own both sides of the trade. Segment 4, Comex math, 42 Oz registered versus 87 Oz demand. Is this market even real? Now the question burning in every comment section, kya ye market real bhi hai? Let's do the math that answers it definitively. Registered inventory reality. February 24th, 88 Oz registered. March 3rd, 42 Oz. 52% gone in 7 days. Largest weekly drain in Comex history. Current open interest implies 87 Oz, March delivery demand. That's 2.07x the physical metal legally available for settlement. Paper to physical ratio 87 demand, 42 supply, shaft 2.07.1. Historical norm 0.8, 1.2.1. Current ratio hasn't been seen since 1980 Hunt Brothers squeeze, 3.1.1 peak. Shanghai versus Comex disconnect. Shanghai Gold Exchange silver spot $86.40, March 3rd close. Comex paper 82.17, 4.23. Premium. Physical dealers report $6 to $8 coin premiums. Real-world bidding above Wall Street paper. Withdrawal patterns. Last 30 days, 146 Oz withdrawn from Comex-eligible warehouses. 78% of total global mine production, 187 Oz annualized. One exchange drained more silver than Peru plus China, combined produce monthly. Delivery notices. March 2nd, first delivery day. 4,872 contracts stood. 24.36 Oz. Shorts issued notices on 3,121 contracts, 19.6 Oz. Remaining open interest still implies 62 Oz potential further demand against 42 Oz supply. This isn't a market, it's a mechanism under stress. When paper promises 2x the physical reality, and physical trades at premium to paper, you have divergence. When divergence hits critical levels, paper breaks or gets rewritten. January 121, 106 happened at 2.1.1 ratio. March 93, $82 at 2.07.1. Same stress, same response. The real question, if Comex is the price of silver, why does Shanghai, world's largest physical market, consistently bid higher during stress? Why do physical premiums explode while paper crashes? Answer, because physical is real, paper is negotiable. And when physical demand exceeds paper supply 2.1, paper gets creative. Cash settlement, rule changes. Technical issues, all legal, all credibility killers. Your physical stack, immune. Their paper game, cornered. Segment 5, January versus March, pixel-perfect replay of Wall Street's silver dump template. Let's line up the crashes side by side with 100% precision. If you still think these are organic corrections after this, you're choosing fairy tales over math. Pre-crash setup, identical. January, silver grinds 98, $121, 23.5% rally, 21 days. Retail FOMO peaks. Comex ratio 2.1.1, March 78, 93, 19.2% rally, 18 days. Retail FOMO peaks. Comex ratio 2.07.1. Crash day 1, identical. January 29th, open 120.10, high 121.80, 1.4% fake out, low 106.40, close 108.20, volume 3.2x. March 3rd, open 87.50, high 88.20, 0.8% fake out, low 82.17, close 82.17, volume 2.8x. Intraday timing, identical. Both heavy selling 10:30 a.m., 2 p.m. ET, 62% of volume. Deceleration 2:04 p.m., 24% volume. Final hour trickle, 14% volume. Immediate aftermath, identical. January 30th, Asia bids $109.50 overnight. NY gap 110.50 open. Close 114.80 plus 6.1%. March 4th predicted. Asia bidding 83.80, 84.20 overnight. NY gap 85.86 open expected. External confirmation identical. January Shanghai premium 380 post crash. March 4.23. Both saw call. Put ratio flip 12.1 plus post climax. Retail behavior identical. January. Silver dead back to $90 forever. Comment spam. March. No, I told you $70. Sell everything spam. Zero deviation. Wall Street runs same template every rally. Grind up, retail FOMO, ratio stress, engineered climax, reload cheap, V recovery. You panic sell $100 to $682 lows. They own $114, $88, $80 bounces. Rinse, repeat. The giveaway? Both crashes hit exactly when Comex ratio crossed 2.1 threshold. Not 1.81, not 2.2.1, 2.1. Mathematical tripwire for naked short intervention. Segment 6. The physical premium. Proof, Shanghai says $86, while Comex says $82. If you want irrefutable proof this market isn't real, look at where physical silver actually trades during crashes. Shanghai Gold Exchange, SGE, data March 3rd Comex close, 82.17. SGE silver close, 86.42, Ford 25 premium. March 4th pre-market, SGE 84.10 versus Comex Globex 83.20, phir 90 premium persists. Physical dealer premiums US dealers, 1OZ Eagles 650 spot 88.67 total. Canadian Maple Leafs 580 87.97. UK Britannia's 420 86.40. Global pattern. India MCX silver, Rs 92 now 500 85.20 USD equivalent. Dubai Souk 87 Oz cash. Singapore, 118, 87.50 USD. Every major physical venue bidding above Comex paper during capitulation. Why? Simple math. China consumed 4,800 metric tons silver 2025, 37% global demand. Solar panel production, plus 122%. Yo, why? EV silver loading doubled versus ICE vehicles. Shanghai stackers accumulated every Comex dip past 18 months. They know deficit, Fronders 207 men Oz 2025. They bid physical reality, not paper promises. The disconnect grows. January 29th, crash. SGE 109.80 versus Comex 106.40, 340 gap. 6 weeks later, 86.42 versus 82.17, 4.25 gap. Premium expanding. Physical pulling away from paper under stress. What this means. When physical trades at premium to spot during crashes, Comex isn't pricing silver. It's pricing paper silver IOUs. Your physical Eagles at 650, real. Their 5,000 Oz futures contract at $80, negotiable. Escape hatch. Physical holders laugh at paper crashes. Paper traders pray for cash settlement. Segment 7. CFTC bank participation. Who's dumping silver? FIR CFTC commitment of traders data tells the real story. Top 8 banks control 62% silver open interest. But a one trader, JP Morgan historically, alone, 22.3%, 112 men Oz equivalent. January 21st, CFTC, pre-$121 crash. One short, 90-day 400 contracts, 492 mounted Oz. Net short, plus 6.7%. February 11th, CFTC, pre-93, 82. One short, 104,200 contracts, 521 mounted Oz. Net short, plus 71%. Crash response, identical. January 29th, number one short covers 18,400 contracts intraday, buys back 12,600 March 2nd, flips net long 8 to 200 by March 4th, March 3rd, expected same pattern, cover 15 to 20K contracts yesterday, reload long $84, $86 today. The math, one bank dumps 92 Meadows Oz equivalent to trigger your stops, covers 46 Meadows at panic lows, flips 41 Meadows Oz long for $114 bounce, $387 paper profit same week. Your $121, $106 loss funds their P&L. Why silver specifically? Gold, central banks buying 1,370 tons 2025. Harder target. Silver, perfect mix industrial, 65% demand, plus monetary, plus retail FOMO. Dual personality, FOS dual manipulation vectors. Regulatory blind spot, CFTC fines, JPM, 2220 spoofing. Same banks plead guilty chat logs. Cap this beach. No structural reform. Game continues. Segment 8, the 133 institutional roadmap. War premium accelerates timeline. Pre-January models, $133 silver, 2030, 2032. 4 to 6% annualized from $85. Post-Hormuz buildup plus March capitulation, 6 to 12 months base case. Revised math, base deficit, 217 meter Aussie 2025, 1.1 B Oz demand versus 885 meter supply. War premium, plus an 18, 27%, 1991 Gulf precedent. Comex breakage, physical repricing, plus 15%, Shanghai premium persistent. Industrial acceleration, solar, plus 122%, EV silver, 2x ICE vehicles. Roadmap $90, weekly resistance 1 to 3 weeks. $105, psychological measured move 1 to 2 months. $115, $120, Comex critical 3 to 6 months. $130, $135, physical takeover 6 to 12 months. Institutional confirmation, JP Morgan March second note to clients. 115, 135, 12-month range realistic under sustained geo risk. Goldman whispering $142 to hedge funds. Your positioning. Survive crashes. Accumulate climaxes. Let asymmetry compound. Segment 9. Global physical bid. Why Asia ignores. Comex crashes Shanghai stacker mentality. 18 months. Every Comex dip house buying opportunity. Accumulated 1-200 Oz 2025. Solar factories hedging forward at 90 plus. EV makers locking Q3 Q4 95 plus. March 4th overnight as recording. SGE silver $84.10 bid pre-open. Britannia premiums PSIV 20. Physical never cared about your $80 paper print. Escape plan 20% portfolio physical. Immune to paper games. Market always returns to metal. Segment 10. Tomorrow's playbook. Survive the next dump watch list. Asia volume 84 plus. Buying confirmation. NY Gap $85, $86 V start. 88.20 reclaim. Structure intact. Risk management. Physical, hold, paper, stops 80-50, size 1-2% risk max. Thesis, deficit plus war plus industrial plus monetary, max structural up, crashes, lag loading zones. You've been watching John AG here, and I'm OG John AG.